We are in the middle of the coronavirus pandemic, and the US has been issuing massive stimulus bills. Now, these stimulus bills are huge. In March, the US passed the CARES Act with $2.2 trillion in stimulus. Just last week, Congress passed a new stimulus bill for $484 billion in stimulus, and there's discussions of another stimulus bill in the works. The United States does not have excess money coming into the budget. So the question is, whenever there's these big stimulus bills, who's paying for them? What happens is the Federal Reserve prints more money.
Yeah, the problem is everybody wants more inflation nowadays, but history shows us that once inflation is out of the bottle, then it can happen pretty quickly. Mark Faber compared it to a ketchup bottle. He called it the ketchup inflation. Once it's out, you cannot put it in anymore. So on this chart, we can see that inflation dynamics can pick up very, very quickly, actually. And I think that at the moment, everybody is underestimating future inflation. But there's protectionism, there's upcoming commodity price inflation, there's wage pressures, there's currency wars going on. There's, of course, lots of political issues that we're having. So from my point of view, a massive surge in inflation is much more likely than the market anticipates.
What does it say in conjunction with gold then?
I think this is a very, very important chart for every investor, because it basically says in times of falling inflation, stocks and bonds have their best environment. But in times of rising inflation, not only bonds suffer, but also stocks. So from my point of view, and this is confirmed by the numbers, stocks are not the best inflation protection. And Ray Dalio, which is of course one of the most successful hedge fund managers, he says the two main risk factors for average portfolio is less than expected growth and more than expected inflation. And from my point of view, as nobody is positioned for an inflationary crisis, you should at least have some portfolio insurance for times of rising inflation. And what works best in an environment of rising inflation? Commodities, oil, energy equities, commodity stocks.
Let's say you're conscientious and you save money. Well, what happens in a period of hyperinflation? Well, your money's wiped out. And so you got to understand what hyperinflation does to a society, because what hyperinflation does is destroy the people who worked hardest to construct the society, because they're the people who've been prudent and careful and sacrificed and so forth. And then when a period of high inflation comes along, poof, everything they have disappears. Because there's also no point in being conscientious and saving things up and storing things if a bunch of thugs are going to just come in randomly and take it all away. So conscientiousness actually only works intelligently in societies that have some medium to long-term stability. You know, because you can get wiped out by hyperinflation too, because hyperinflation kills off the conscientious people. The people who accrued debts are thrilled when hyperinflation kicks in because it wipes out their debts. But of course, those debts are the things they owe to people who were conscientious enough to save. But the hyperinflation wiped out all the people that were prudent and saved, and left them with a terrible sense that the entire system had betrayed them, which is of course exactly what had happened.
Hyperinflation in Germany in the 1920s, where at some point prices doubled almost every 4 days. Hyperinflation occurs when the inflation rate increases very rapidly, resulting in prices going up very fast and the currency losing its value quickly. One of the most amazing hyperinflation cases in history happened in Germany in the 1920s. As the result of World War I, the German paper mark started to lose its value, and this process accelerated in the 1920s. In 1923, prices eventually ran out of control. The prices went up so much that people were forced to spend billions of marks for daily items and were dizzied by the amount of zeros involved. As an example, a loaf of bread which cost 250 marks in January 1923 rose to 200,000 million marks in November of 1923. Or a newspaper that was sold for 1 mark in May 1922 had a price tag of 70 million marks in November 1923. It was cheaper to use the back of a 1 million mark to write notes, as a notepad would cost billions of marks. Some had to use wheelbarrows filled with cash to get a cup of coffee. At restaurants, customers had to negotiate the price of the food in advance, as there was a good chance that the price could change before the meal was served. Most restaurants did not print menus, as by the time the food would arrive, the price had already gone up. At some point, the situation got so bad that the prices were doubling almost every 4 days. There is evidence that it was cheaper to burn marks instead of wood or coal. Some used marks instead of wallpaper to decorate their walls. Children also used bundles of marks instead of toy bricks. Workers also had to negotiate their wages almost on a daily basis. Some had to use a scale to count the weight of their money to get its value, as it was difficult to count all the bills. Workers were paid twice a day so they could spend the money quickly before it lost its value.
You can just print more money, which is exactly what Mugabe did. The newly printed money didn't increase productivity in the Zimbabwean economy, and there was no new investment, so the economy couldn't produce more goods. In effect, you had more money chasing the same goods. More money chasing the same goods meant that the purchasing power of the Zimbabwean dollar fell. You needed more dollars to buy the same stuff as before. In other words, as the newly printed money began flooding the market, prices began to rise. Prices began to increase at a rate of about 50% a year, and that was only the beginning. As prices rose, the government had to print even more money to buy just as many goods as before. And so they did. And that is how things got out of control. The faster prices rose, the more money the government printed. And the faster prices rose. A feedback loop. By 2001, prices were rising at a rate of 100% per year. By 2002, 200% per year. 2003, 600% per year. By 2006, prices were rising at over 1,000% per year, and it cost 417 Zimbabwean dollars to buy toilet paper. No, not per roll, $417 per sheet. Money was devaluing so quickly that the money you had in the morning would be worth quite a bit less by the evening. So people were trying to get rid of currency as soon as they got it. Zimbabweans became millionaires, but unfortunately, 1 million Zimbabwe dollars might buy you a chicken, if you were lucky. And still the government kept printing money, and in higher and higher denominations. $1 million notes, 100 million, 10 billion, $100 billion notes. In 2008, prices started rising by thousands of percent a month, and the government started printing $100 trillion notes. At the height of this feedback loop, prices were increasing at an astronomical rate of 7.6 billion% a month, and $1 would get you, well, we're not sure how to say it, but this many Zimbabwean dollars. By the end of 2008, the Zimbabwean dollar had effectively ceased to exist, and Mugabe had no choice but to legalize transactions in foreign currencies. The Zimbabwe hyperinflation was over. Hyperinflations have occurred in other countries such as Yugoslavia in 1994, China in 1949, and Germany in 1923.
The Zimbabwe dollar was actually a pretty strong currency. At the time, in 1986, it was roughly $1.53 Zimbabwe dollars to $1 USD, making that a very strong currency to the strong US dollar. In 1986, silver prices, March 1986, silver prices were $12.75 per ounce, and the Zimbabwe dollar was $19.51 Zimbabwe dollars per ounce if you were to adjust for that exchange. So basically $19.51 Zimbabwe is going to buy you 1 ounce of silver. Now, over the next 20 plus years, Zimbabwe is going to go through some spouts of inflation and even hyperinflation to the tune that it will completely destroy and demonetize their currency. Did this demonetize the value of silver, however? Of course not. And that's why it's always good to invest in silver and gold as a way to protect against things like inflation, hyperinflation, and of course, a good way to store value. For a very good example of that, we'll fast forward 22 years. In 1986, again, it was $1.53 Zimbabwe dollars to $1 USD. However, in January of 2008, it was 6 million Zimbabwe dollars to $1 US dollar. So that is an increase of millions and millions of percent, an insane amount. So for example, you could have bought these ounces of silver for $19.51. However, that same ounce of silver in Zimbabwe dollars of January of 2008 is going to be $117.42 million. That is a huge increase. And now between January and July 2008, that's when Zimbabwe really experienced the massive hyperinflation that completely destroyed its economic system, caused them to reissue their currency multiple times. In July 2008, the Zimbabwe dollar was $758,530,000,000 per 1 USD. So essentially, 1 US dollar was equivalent to 758 billion Zimbabwe dollars. So that made 1 ounce of silver in July 2008 $14.574 trillion. And keep in mind, at the time, silver was $19.61 USD in July 2008, or $14.574 trillion. Now, if you had a whole lot of money in 1986 and you lived in Zimbabwe and you had a whole lot of Zimbabwe dollars, you may as well wallpaper your house with it. But if you would have invested that money into silver and gold in 1986, you would not have lost wealth, but instead would have actually gained wealth. So you see the correlation between using silver and gold as a way to protect against hyperinflation. That's a perfect example. So your 1 ounce silver coin that you bought in Zimbabwe for $19.51 is now worth 14.574 trillion Zimbabwe dollars in July 2008. So essentially, you didn't lose money, you gained money. That, guys, is why I always recommend stacking at least some silver and gold to store your wealth, or a good way to prevent against hyperinflation.
The Venezuelan dollar, the bolivar, has become so worthless that 1 US dollar will get you 925,000 gallons of premium gas in Venezuela. Okay, now this article goes to point out here that hyperinflation made the bolivar essentially worthless, so there's a black market for the US dollar. 1 bolivar now is, 1 US dollar is trading for 3.5 million bolivars. Okay, now as far as socialism, they're voted one of the most socialistic countries. All the social programs, things like that, food programs, endless printing and creation of the currency. Does that sound familiar? US dollar. So the subsidies there are just part of the picture, but what happens when you have a lot of subsidy, it creates more demand for goods and items and even food. Inflation has gotten so bad that many people, especially in the bigger cities, cannot get food. And it's so bad that, and this is not for the faint of heart here, pets are on the menu as Venezuelans starve. Currency has become so worthless that Venezuela doesn't have enough money to pay for its money. I'll repeat that. They don't have enough money to pay for its money. So the cost of printing the money now exceeds what the money's even worth. So in order to buy basic goods in some cases, you have to walk around with wheelbarrows full of money. Now this is a shot out of Zimbabwe. It's the best one I could find that demonstrates how many bills you need because of the hyperinflation and the collapsing of the currency. But take a look at it here. This is life in Venezuela and other countries that have had hyperinflation. Okay, now here's a chart here of the Venezuelan dollar, the bolivar, and this only goes back about a year, but you can see the devaluation, how it was gradual at first, and then all of a sudden the bottom dropped out. So most people did not have time to prepare. By the time it started dropping, the rush to transfer those bolivars, those dollars, into something of value, such as precious metals, or maybe just stocking up on supplies and food before the dollar, their bolivar, became worthless. Well, as you could see, the bottom dropped out so quickly, many people were basically stuck. But having nothing versus having some metal, well, gold didn't crash to zero, and it will likely never crash to zero because it has value in and of itself. It's a limited commodity, or a limited asset, whatever you want to call it. So precious metals was successful as far as we can see with all the data here.
But inflation, when it really gets out of control, and last month a cup of Joe in Venezuela would have cost almost 2 million bolivars, and only a year ago it was 2,300 bolivars, a price increase of nearly 87,000%. unbelievable. Countries such as China and Russia continue to add to their holdings. Venezuela has been the world's largest seller of gold for the past 2 years. The only thing that's helping Venezuela pay its bills right now is gold. 2 years ago, it held the world's 16th largest gold reserves. Today, it stands at number 26, since the country has sold off half of its holdings since 2010. So what do you think an ounce of gold in Venezuela bolivars costs today? 211 million bolivars. Unbelievable.
Again, in terms of having people protect themselves, we talked about foreign exchange, which obviously meant gold. Tangible assets, was that another way that they were able to protect themselves?
I mean, this business of havens, which we see so much nowadays, was very much in vogue. First, you tried to get foreign currency, and the best ones to hold were the Swiss franc, the guilder, the two neutrals, and dollars, and to some extent sterling. So you went for those if you could. Failing that, you got rid of your money. This is by talking about 1923, when inflation was becoming so extraordinary. You simply took your money, bought a share if you could, because the stock exchange was still working very well, or you converted it into whatever you could persuade anyone else who was desperate for money to part with.